Welcome to Investor Web, your trusted source for expert investment advice and strategies. We're here to help you navigate the vast and often complex world of investing. Whether you're a seasoned investor or just starting out, our mission is to provide you with valuable insights and practical tips to make your financial journey a profitable one. From the bustling world of stocks and bonds to the exciting realms of real estate and cryptocurrencies, we delve into a spectrum of investment opportunities. Each month, we'll explore different investment strategies, shining a light on how to grow your wealth one investment at a time. Our focus is not just on the what and where of investing, but also the how and why. So, strap in for a voyage into the world of investments, where we break down complex financial concepts into understandable, actionable steps. Dive into the world of investments with us and take your financial future into your own hands. Investing in stocks can be an effective way to build wealth over time, but what exactly does it mean to invest in stocks? Well, when you purchase a company's stock, you're buying a small piece of that company, becoming a shareholder. This allows you to participate in the company's success through increases in the stock's price and dividends that the company might declare. Now, stocks do offer the potential for high returns, especially in the long run. However, they're not without risks. Stock prices can be volatile, fluctuating up and down based on the company's performance and market conditions. So, how can you navigate these choppy waters? Research is your compass. Understand the company you're investing in, its business model, and the industry it operates in. Patience is your anchor. Investing in stocks is not about making a quick buck, but about growing your wealth over time. And diversification is your life jacket. Don't put all your eggs in one basket. Spread your investments across different sectors and companies. Remember, the key to successful stock investing is research, patience, and diversification. Bonds are considered a safer investment compared to stocks. Now let's delve into why. Picture bonds as IOUs, where you lend your money to a government or a corporation for a specific period. In return, they promise to pay you back with a bit of interest. Think of it as a formalized promise to repay a loan, but in this case, you're the bank. The allure of bonds lies in their stability. Unlike stocks, which can fluctuate wildly, bonds are steady performers. They offer regular interest payments, providing a consistent stream of income. This stability is why many investors include bonds in their portfolios. They're the tortoise in the classic tale of the tortoise and the hare. And even though the returns might not be as high as with stocks, the predictability is a major selling point. You know what you're getting and when you're getting it. While the returns might be lower than stocks, bonds offer more predictability and less risk. Mutual funds allow you to invest in a diversified portfolio without having to buy each security individually. The beauty of mutual funds lies in their simplicity. You're essentially pooling your money with other investors to buy a wide array of stocks, bonds, or other securities. This offers a level of diversification that would be challenging and costly to achieve on your own. Moreover, mutual funds are professionally managed. This means that there's a dedicated team of experts making investment decisions on your behalf, so you can focus on other aspects of your life. Another advantage is liquidity. With mutual funds, you can buy or sell your shares on any business day. This flexibility is a boon for investors who might need to access their money on short notice. In essence, mutual funds can be a great option for those who prefer a hands-off approach to investing. They offer diversification, professional management, and liquidity, all wrapped up in one neat package. Real estate can be a valuable addition to your investment portfolio. As tangible assets, properties offer a sense of security that is often lacking in other investment vehicles. They weather economic fluctuations and over time generally appreciate in value. Investing in real estate can be a fruitful venture for those seeking a steady stream of income. Rental properties, for instance, can generate consistent cash flow month after month. This can be a great way to supplement your income or even replace it entirely. Moreover, the potential appreciation in property value is another significant benefit. As communities grow and develop, so does the value of the properties in those areas. This can result in a substantial return on your investment when you decide to sell. But remember, like any investment, real estate comes with its own set of risks and challenges. It requires due diligence, market knowledge, and sometimes a good deal of patience. Real estate can provide a steady income stream and long-term financial security. Cryptocurrency is a high-risk, high-reward investment. Now, what exactly is cryptocurrency? It's a digital or virtual form of currency that uses cryptography for security. Unlike traditional currencies, cryptocurrencies operate on a technology called blockchain, a decentralized system across many computers that manages and records transactions. The world of cryptocurrency is a volatile one. Its value can skyrocket one day and plummet the next. This volatility can lead to significant losses, but also the potential for high returns. Think of Bitcoin, which started at mere pennies and hit an all-time high of nearly $65,000 in April 2021. However, it's crucial to remember that with high potential returns come high risks. Cryptocurrencies can be unpredictable, and investing in them should not be taken lightly. This is an investment for those who have done their research, understand the risks involved, and can afford to take on more risk. Cryptocurrency is for those who can afford to take on more risk in exchange for potentially high returns. Exchange-traded funds, or ETFs, combine the best aspects of stocks and mutual funds. Imagine having the agility of a gazelle with the sturdy dependability of an elephant. That's essentially what an ETF offers. Just like stocks, ETFs can be bought and sold throughout the trading day at fluctuating prices. This allows for a level of flexibility that mutual funds, which only trade at the end of the day, simply can't match. On the other hand, ETFs mirror the benefits of mutual funds by offering diversification. Instead of putting all your eggs in one basket, ETFs allow you to spread your investment across a range of assets. This reduces your risk and can lead to more stable returns. Whether you're a seasoned investor or just starting out, ETFs can be a great addition to your portfolio. They strike a balance between the high potential returns of individual stocks and the risk management of mutual funds. ETFs provide flexibility and diversification, making them a popular choice among investors. Index funds are a type of mutual fund that aims to replicate the performance of a specific index. Picture yourself as a voyager on an investment journey, and think of index funds as the reliable, sturdy ship that keeps you afloat amidst the turbulent market waves. So what makes index funds a worthy vessel for your investment voyage? First off, they offer diversification. By investing in an index fund, you essentially buy into a slice of the entire market. That's right, you're not putting all your eggs in one basket, but spreading them across numerous stocks or bonds. Secondly, index funds are cost-effective. Unlike actively managed funds, where professionals are paid to pick and choose stocks, index funds simply mirror a specific index. This passive approach translates to lower fees for you, the investor. So, if you're seeking an investment strategy that's both diverse and economical, look no further. Index funds can be a simple, cost-effective way to invest in the broader market. Peer-to-peer lending platforms allow you to act as a bank, lending your money to others in exchange for interest payments. Now let's dive into this a bit deeper. Peer-to-peer lending, often abbreviated as P2P lending, is an innovative method of debt financing that directly connects borrowers and lenders through an online platform. The beauty of P2P lending is that it eliminates the need for traditional financial intermediaries like banks. So, how about the returns? Well, they can be quite attractive. Generally, P2P lending can offer higher interest rates than what you'd receive from a traditional savings account or certificate of deposit. But, as with any investment, there are risks involved, the primary risk being borrower default. Unlike a savings account, your capital isn't guaranteed in P2P lending, so it's crucial to diversify your investments and only invest money you can afford to lose. Peer-to-peer lending can be a good way to earn higher interest rates than traditional savings accounts. But remember, always do your due diligence before making any investment. Gold is a traditional safe haven investment. For centuries, societies have placed a high value on this precious metal. It's not just a symbol of wealth and power, but it's also a practical tool for financial stability. Investing in gold can be an effective way to diversify your portfolio. It has a unique inverse relationship with the stock market, which means when stocks go down, gold prices often go up. This counterbalance can help mitigate losses during market downturns. Moreover, gold serves as a hedge against inflation. As the cost of living rises, so does the value of gold. This can protect your purchasing power in the long run. Additionally, gold can safeguard against currency fluctuations. If your home currency weakens, the value of gold in your portfolio could provide a much-needed buffer. But remember, like any investment, it's important to understand the market and your own risk tolerance before diving in. Investing in gold can provide stability and protection in uncertain economic times. Investing in retirement accounts can provide tax advantages while helping you save for the future. Now, let's delve deeper into the benefits of these accounts. Retirement accounts like 401ks and individual retirement accounts, or IRAs, offer a distinct advantage. Tax deductions. This means that the money you put into these accounts can reduce your taxable income, leaving more cash in your pocket at the end of the day. But the benefits don't stop at tax breaks. The magic of compounding interest works wonders in these accounts. This is where your earnings generate even more earnings. Over time, this snowball effect can potentially turn your modest contributions into a substantial nest egg. Remember, the earlier you start, the more time your money has to grow. Think of investing in these as planting a seed that will grow into a mighty tree, providing shade in your golden years. Investing in a retirement account is an essential step towards securing your financial future. Investing wisely can lead to a richer life. So we've traversed the landscape of 10 investment options, each presenting its own unique opportunities and challenges. From the ever-evolving world of stocks, bonds, and mutual funds to the tangible solidity of real estate and gold. We've delved into the digital realms of cryptocurrency, the diversity of ETFs, the simplicity of index funds, and the community-based approach of peer-to-peer lending. And let's not forget the long-term security of retirement accounts. Each of these investment vehicles carries its own set of risks and rewards, and the best choice for you ultimately depends on your individual circumstances, financial goals, and risk tolerance. It's about finding the right balance, the sweet spot, if you will, that aligns with your financial aspirations and life ambitions. Remember to like this video, share it with your friends, and subscribe to Investor Web for more investment advice and strategies. Until next time, invest wisely and live richly.